What's going on, guys? This is Lior and welcome back to my channel. Now, what I thought I would do in this video is talk about how private capital, right, and sourcing private capital for your real estate business can really help you scale out your portfolio, right? Because a lot of investors may purchase a property or two using their own funds, and then they quickly get tapped out with how much property they can buy, right? They want to buy more, they just don't necessarily have the cash. So private capital becomes an essential part of scaling out one's portfolio. So I'm going to talk about how to use it, the different structures you can use it with, and hopefully this will help you guys scale out. So with that, let's get at it. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes of the video, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I'm putting out tons of new content every single week on this channel, talking about everything multifamily, from construction, operations, underwriting, raising money, and literally everything in between. So if that's the kind of content you're looking for, make sure you subscribe. So let's get right into it and talk about private capital, right? And as I said, a lot of investors first start out with, let's go buy some real estate with our own funds, right? So, they might save that 25% down payment and go buy a smaller multifamily, right? And, some people will do that once and then they kind of get tapped out. If you have some more liquidity, or maybe if you're a high earner, right? Maybe you can refuel yourself a couple of times and buy multiple properties like that. But at some point, a lot of investors get to that point where they're like, well, if I just had another source of capital coming in that would allow me to continue to buy deals, that would be awesome, right? Because that would really help me scale out and buy more, maybe buy bigger buildings as well. And this is where private capital comes in, right? It's essentially capital that's more money that's sitting in other people's accounts that they're not using. And you can essentially use that cash to fund your own deals, while still returning a really good return for those private capital investors, right? And, with private capital, there's typically two ways to structure a deal, right, at a high level. You can either, in return for getting the funds from an investor, you can either give someone what I call equity, right, or a percent ownership in the deal, or you can take that money as debt, right, and basically treat it almost like a mortgage, right, except it's typically unsecured, and they're getting some sort of fixed return on their money instead of ownership in the deal. Now, you can see how powerful this is, right? Because if you can get, let's say, a good amount of capital that is not being used into your business, you can go and use that and purchase a lot of real estate, right? Again, while providing those investors really good returns. Now, the general idea, if you're gonna start to go down that path, is most people that raise capital don't go out and buy turnkey opportunities. And here's why, right? Unless you're a major institution, right, when you're just, you're funneling billions of dollars and, investors are happy with just a few percentage returns, right? More than likely, you're gonna have to provide a pretty competitive return profile for your investors, right? So whether it's equity, whether it's debt, you're gonna need to create a lot of profit on each deal in order to sustain and substantiate raising the money and paying the investors back whatever they're due. Right? So typically when you're raising private capital, you're gonna go after more distressed real estate. The level of distress can vary quite a bit, right? But typically there's something that's not perfectly turnkey, right? Maybe you're looking at multifamily that needs complete rehab to the studs. Or maybe it's a pretty solid building, but it needs some work and maybe needs some kitchen and bath lifts. That way you can increase the rents and increase the value, right? But typically there needs to be something in there, right? Where you as the operator can provide value for being the operator to those private capital investors, right? So you got to get good at providing value, right? And, closing on turnkey real estate, even though it could be value to some private capital investors, right? Where they, say, I'd rather just put it in there with limited returns. Most private capital investors are gonna want bigger returns. You're gonna have to figure out a way to create that meat on the bone. Now, as you go after distressed projects, you're gonna have to figure out how to structure the deal. So let's talk a little bit more structure, right? And as I said, right, you have the equity structure and the debt structure. Now, a big component of this decision will depend on the type of deal and the risk profile you're willing to accept on executing the deal, right? Because if you think about it, if you're raising private debt, that's additional debt that you're essentially levering up on the property, right? So if you're putting mortgage debt and then an additional private capital debt, you have a lot of debt on that property. So you got to figure out, how am I going to pay off all this debt and return all the principal, right? So when I've raised debt for my projects in the past, it was typically in situations when I know I can get in, do the work immediately, I won't have any delays, I know I'm going to create a lot of value, and then I can either refinance or sell to return the principal and the interest payments to the investors that have funded it, right? And a great example of this would be, like I bought a vacant 4-unit building in Boston. We completely gutted it to the studs. Everything was brand new. Spent $650,000 in construction, but we created so much value in that building that we were able to refinance and pay off the principal and interest that we borrowed from investors. Now, when would I not use that? Well, if you've got a building that might be slower to turn over, right? Because, that was a quick turnover, right? When I bought that vacant building, I was able to get in, get out within a span of about 7-8 months or so, right? But, if I had existing tenants, for example, right? And I wasn't sure I'd be able to get in and get out as quickly as I thought, I might have not done it with that structure, right? Because that debt would, it would start compiling. And if I didn't feel confident I could get in and do the work that I needed to, I could get in potential trouble, right? So equity would be a good structure for that kind of scenario, right? Where maybe you've got tenants in, you're going to be turning them over as they leave the apartments. And let's say that happens over the course of 1 to 2 years. That's a really good structure to have, right? Because it's not like there's a ticking time bomb on that debt, right? Usually equity means you're involved in the deal. It doesn't have like a 12-month term or 6-month term or 18-month term, whatever it may be. And it's a lot more patient, right? There's not like interest accruing in every day. That equity can essentially be your partner and be patient as you do what you need to do and turn over units, do your construction, and raise the rents. So you can see that, you have to be a little bit creative, but you also have to understand the risks of each deal, right? So if there are deals that you think are going to be more complicated and you don't have, really exact timelines, raising debt can be really tricky. Whereas, if you have deals that just have a lot of components and there's going to be a lot of turnovers and it could be a couple of years as you turn things over, then having equity is also a great strategy to use. Equity also in general would be considered safer, right? Because you're not piling that property up on a ton of debt. I have to give this warning, right? I mean, if you're going to do that strategy, debt is a tool, but it goes both ways, right? If you use it properly, it can be amazing and create amazing returns. But if not properly managed, you can get yourself in a world of hurt. And I've seen other operators get into that world of hurt. So be careful about that, right? So hopefully that's helpful, guys. Hopefully that kind of gets your mind going about the different structures of private capital, when to use each type of structure, because as I said, it's a really great tool that has allowed me to scale out my portfolio really rapidly. A ton of other operators have used it. It's just a great strategy, but you have to know when to use each type of tool under what structure to make sure you're not putting yourself in danger, and to make sure at the end of the day you can continue to provide returns to that private capital, right? Because that private capital, if you treat it right, is going to be an awesome source of business for you in the future. It'll keep helping you fund deals, allow you to scale and grow out more. So hopefully that's helpful, guys. That's kind of my take on private capital and scaling. Hopefully that's helpful. If you guys have any sort of questions, make sure you put them in the comments below.